afternoon, good morning. Welcome to our IPO Bootcamp, which we've dubbed the IPO process and the secrets to successful execution, timing and legal considerations, valuation, and the roadshow pricing. My name is Chris Maggos. I'm head of Europe for LifeSci Advisors, and I'll be moderating the panel. I'd like for our panelists to briefly introduce themselves, and then we'll get right into the discussion.
Nathan Ajiashvili. I'm a partner at Latham and Watkins in New York.
Go ahead, Mike.
Michael Rice, founder of LifeSci Partners.
Nick?
Nick Moore, Managing Director, Healthcare Investment Banking at Stifel.
And Filippo.
Filippo Petti, CEO and CFO of Celyad Oncology.
Okay, before we get into the specifics of IPO readiness and IPO process, there are alternatives, and I'd like to just briefly spend a couple of minutes talking about the alternatives, such as a SPAC, which has been very popular this year, reverse mergers, direct listing, or even trade sale. So I don't know, Mike, do you want to start since you've been working on some SPACs?
Sure, happy to start, Chris. So I think right now we're in an environment that SPACs are somewhat all the rage, right? There's been a number of SPACs that have come public. I think if you asked the question to the panel a year ago, I think the answer would be the exact opposite, particularly in this space, in the healthcare world. SPACs were sort of a dirty word. You've had a couple of success stories. You've had some high quality folks invest in SPACs. You've had some companies that have done SPACs that have done extremely well, like Immunovant, et cetera. There's going to be much more financings of SPACs. There's going to be much larger SPACs done. Again, as you think about SPACs and the alternatives, whether they're reverse mergers or direct listings, SPACs are a really unique vehicle for a variety of different reasons. But clearly, it's a clean shell in a sense, with lots of money sometimes on the cap table to start. So it's a great starting point. The challenges that exist, obviously, you've got to build a shareholder base. It is a process. You've got to go through the capital raise process, the de-SPACing process, but certainly a very high quality alternative. And as we're seeing the momentum pick up, my view is you're going to see more of them. So happy to talk about our SPACs, other SPACs. Happy to talk about reverse mergers as well, Chris, if you want me to do that. But I think to your point, it's a great question about different alternatives. And my view is you're going to see many more SPACs that are going to come public here in the relatively near future.
Nick, do you see companies pursuing this in parallel to an IPO, or how is this coming up in your practice?
Yeah, not so much in parallel. I mean, we tend to see people sort of making a decision fairly early on. And look, I think for a lot of folks, the regular way IPO is still the preferred route, going through a crossover round to enable that to happen. But, I think, the SPAC route and particular, the reverse merger route, allows companies that are good public companies, but maybe not necessarily the best IPO candidates, access to public markets. So I think, it continues to democratize access to public capital in the US.
Nate, from your point of view, how is it?
We have clients, like yourself, Chris, and Mike and Nick noted, that are constantly asking about the SPAC process, the direct listing process. Is this right for me? Right? I mean, that's the initial question. How do I know this is right for me? But as Nick noted, in the healthcare space at this time, the vast majority of our private clients are seeking the traditional IPO route in the U.S., listing on Nasdaq. But as Mike alluded to as well, we're seeing more and more interest in the SPACs. Folks may not want to go through the traditional crossover route. Folks may not want to go through building up the traditional US VCs in order to consummate a US IPO. The SPAC is that alternative. It is a I think I would say, from a timeline perspective, slightly quicker way to be a U.S. registrant, but you still have the de-SPAC process. You still have, the financing after the de-SPAC process too. And so overall, I would say it's comparable to the traditional IPO process in the U.S. So, but I think overall from the market, it is a good thing, right? The more players you have here, hopefully that increases the valuation for all biotech companies, private companies seeking to go public. So, it's all good for the private companies. More and more alternatives to go public on the U.S.
Great. And any other thoughts on that before we move on? I think it's not uncommon for companies to pursue IPO and trade sale in parallel. But it's interesting that, SPAC is perhaps something that's more focused, or reverse merger, where it's a clear goal and not an option that's being considered along with other possibilities.
Chris, I think the additional point is that it is an incredibly competitive process, these SPACs, right? So, we looked at, Andrew, my partner, looked at probably 250 companies that he whittled down that process to a handful, and then ultimately we're in final term sheets with a company. But it was a long process, similar to a reverse merge, but probably even more competitive than a reverse merge process. And so, again, I think it is an alternative, unlike a book building process, right? It's a lot of work post being, a public company. Not to say it's not a lot of work once you're a public company, because it is, but when you're a SPAC, it's a whole different animal where you've really got to get out and market the story to the broader investor base, as opposed to doing test the waters and building a book, et cetera, going through the traditional process, which, obviously you're really building visibility.
To that point, is there something specific about the profile of a company that makes it appropriate for a SPAC versus an IPO, or is it a preference?
I think it's the latter. The team on a panel, let me know if you disagree with your clients, but I think it's the latter. I think if some, companies, look, if you get an offer from a particular SPAC and it's an attractive offer, that's something to entertain. It is I think an efficient way or a quicker way to go public. But again, I want to emphasize what Mike just noted. There's still plenty of work to do with the shareholder base post, the de-SPACing process. You're going to still have the financing most likely after the de-SPAC occurs. And so you're not front loading that work, in a traditional IPO sense. So you're just going to backload it to the first financing, post, the de-SPACing phase. But again, if there's an attractive offer, it is a quicker way to become a U.S. registrant than the traditional IPO process.
And Nick, just maybe last word on this. I mean, do you think there's a stigma that has been attached to SPACs that's no longer there, or is it something that's you're sort of a lame duck out of the gate?
No, look, you're absolutely right, and I think particularly reverse mergers historically, it was sort of the port of last call for a company seeking a US listing. And, it's become, a much more accepted path. The SPAC is now, particularly in this year of all years, a very popular and frankly, credentializing path to US public markets. So, I think, historically it's been sort of law of small numbers, companies that couldn't get a crossover round done, that couldn't do a regular way IPO, looked at a reverse. And, I think that, a lot of that stigma is indeed gone now.
And there are a lot of prestigious investors already in these SPACs. So that's obviously something that would lend credibility.
Right, and oftentimes that is quite a distinction between a SPAC and a reverse candidate, right? Where you have a fallen angel with some cash, maybe not the greatest shareholder list in the world, versus a SPAC, which is set up by some very high quality promoters.
Okay, let's shift gears and get back to the subject. Filippo, I'm sorry, I'm going to put you on the spot since Jordan from Nasdaq, who was supposed to be with us, is not here. Can you just give us a broad overview? I know with your financial background, this shouldn't be too hard for you. A broad overview of the IPO process to set the stage for the discussion that's going to come.
Yeah, happy to do so, Chris, and thanks for the opportunity. Look, I think it's some of the points that have already been made from Nicholas and Michael and Nathan as you kick off the IPO process, having that crossover round as you go through your series, your potential private investments, kicking into a crossover and heading towards the IPO process is key. From soup to nuts. The bake-off, being able to select the right syndicate for yourself, the drafting. I mean, being able to really coordinate through the different steps within the process, and most importantly, I think, is that connectivity to investors. There's a ton of work that goes behind it, everything from drafting to testing the water meetings to eventually going on file, the IPO roadshow. And landing that first trade, hopefully in the open market where you feel that you've kind of made that big splash. So it is a commitment. It is certainly also a focus of timing, right? It's got to be the right place and right time. So a lot goes back into the process and making sure that you have a coordinated team to really help you get through the threshold there.
Let's talk about IPO readiness. Nick, you are constantly evaluating which companies Stifel would work with. How do you guys decide when a company is ready?
Yeah, sure. So look, I think that really breaks down into a couple of buckets, right? Firstly, there's all the mechanical stuff in terms of have you got good lawyers on board? Have you got good accountants on board? Are your numbers going to be ready in time? Have you got the right people on the board? Have you got the right board committees? Is corporate governance, applicable for the Nasdaq market? And, I wouldn't exactly go so far as to say they were administrative items, but they're more sort of housekeeping and process items, and obviously very important. But look, I think the other sort of critical bucket is readiness in terms of maturity of the story, maturity of the data, maturity of the management team, maturity of the engagement with US crossover and public market investors. And as you know, one of the reasons that we love working with LifeSci so much is because you do such fantastic work getting your clients in front of those accounts to enable the crossover and to ultimately de-risk the IPO when we know that there's going to be good demand there coming off the back of multiple engagements over multiple months.
Mike, do you want to pick up there and talk about readiness and how we help to mature that?
Yep. And Nick, thank you for the kind words. We love that. But yeah, I mean, I think everybody on this call knows the lawyers, the auditors, the numbers, the data, the board, the governance process all needs to be in place. There's no question about it. But I think in our view, from our perspective, the key factor here is the investor interest level, right? And, from, again, our perspective, when we talk to private companies, it's super important to make sure that you've got enough visibility on the street, enough investor engagement to go through a smooth book building process. And so essentially what we tell our companies is you really need to set sort of 12 to 18 months of a runway to really familiarize yourself and with the investors and the investors with you. And so running a process of, call it 12 months prior to being a public company, is really the appropriate amount of time to get ready. What you don't want to do is meet high quality investors for the first time with your hand out asking for money. That is not the right way to go about this. What you really want to do is build relationships with those investors, build relationships around the KOL community and investors, build relationships with all your banks, make sure you understand each role that they're going to play. So the process, it's a long process, but ultimately what this is all about is driving enough visibility in the investment community, all the other constituents and stakeholders as well, but particularly knowing going into this process that you are going to have interest from those shareholders.
So if I could jump in here real quick, 100% agree with what Nick and Mike just noted. And let me talk about some more of the blocking and tackling, right, from the legal side too. To have an efficient and satisfactory IPO process, it is best, as Mike noted, to get out in front of the investors 12 to 18 months. That's great. That's a sweet spot. But while you're doing that, gear up for IPO from a documentation point of view. Have that corporate housekeeping meeting internally, right? And hopefully Phil can talk about this too, given his role at the company, right? Understand who your point people will be in the IPO process. Understand where some of the holes are with respect to compliance, with respect to financials, with respect to internal controls. Start drafting an equity story, right? For our clients, we love it and we encourage and we obviously assist for day one at that org meeting. We have a S1 or an F1, depending on the issue, of course, and a business section draft, right? That tells the equity story, that tells the clinical program story, that talks about your milestones, 85, 90% of the way there. If you have that draft, if you have that corporate housekeeping done with the diligence data room, the draft of the F1, you're going to have a much more efficient process. These timelines have become more and more compressed. The SEC is much quicker with respect to getting through their comment process. It's still 30 days, roughly 27 to 30 days to get that initial comment letter back. But after that, we're getting through the SEC in an amendment or two, right? And so it is imperative, to be ready before you kick off, right? Because here you are 2 months after kickoff, 3 months after kickoff, you're ready to go on the IPO roadshow, right? You're ready to actually be out there and potentially publicly file a document. And so during the time we were speaking to investors, also understand internally how the organization is looking, understand the board, understand your management team, understand your equity structure, understand your comp structure. All these questions need to be asked. All these questions should be answered. If not prior to the org meeting, you have a path to answering them during the IPO process. It'll make for a much, much more efficient and satisfactory IPO process.
Nate, maybe you could just go into a little bit more granularity there in terms of who exactly are the key players that the company needs to start engaging with. And Filippo, it'd be great to get your view after that on how the internal management team needs to organize itself to get ready to go through that process and engage with these players.
Well, the players are people on this panel, right? Great IR, great banking, at least one or two contacts to shepherd that process along, right? Before you kick off an IPO, as Mike noted, he said it so well. Developing relationships, right? I think that's key here. Developing relationships with your banking partners, with your legal partners, and I'm stressing that word partners because that's how I see it when we partner with our clients to shepherd them through the IPO process. So the bankers, guys like Nick, your team, Chris, but also the analysts at these banking institutions, obviously very key. And to get to them early, it's helpful before the onboarding process happens at the banks, and then the type of feedback you can get from the analysts is a little bit different. And so understand the research analyst. That is also a critical component of the IPO process as you build your syndicate. The syndicate is the team of investment banks that are going to take you public. In the healthcare life sciences space, it's typically 4 or 5 investment banks that'll be on the cover and they'll be underwriters for your IPO. Know those banks, know their teams that are going to shepherd that process, that are going to tell your equity story, that are going to set up the TTW meetings throughout the IPO process. Know the ECM teams, the equity capital markets teams, not just your banking coverage teams. Those equity capital markets teams in their syndicate are going to actually sell your offering to the investors. And of course, know the analysts, right? Those are the teams that are going to help you during the IPO and then post IPO, right? They're going to ones that are going to have an interface with the investors, with the street, to talk about your equity story. And of course, then roughly 3 weeks after we price the transaction, they will publish their first note, specifically 25 days after you price your transaction. So the banking team is going to be the one really going to navigate you through the process. Lawyers are going to be shepherding all the legal stuff, getting you right and ready to execute an IPO well, getting you through the SEC process, setting yourselves up for success post-IPO. It is critical that companies, and Phil can attest to this, that this is just another financing. It has a high regulatory bar. It's more expensive. We get it. But it's just another financing. And really don't forget what got you here, and make sure that this financing sets the company up for long-term success. So understand those players: lawyers, IR, accountants, banking, research, ECM, underwriters council is also helpful too. All those players, are going to be critical to make sure that you have a very efficient and productive IPO. Again, to setting yourselves up for success as a public company in the U.S.
It's striking hearing you talk. You're talking about 3-4 key people at each bank, plus the law firm, another 3 or 4 people. So you're starting to talk about getting to know and have a working relationship with 30 to 40 people, essentially, right?
Yeah.
Once you have the whole crew assembled.
Indeed. And that's the org meeting size too. That org meeting when we all get together, well, pre-COVID when we all got together, now it's all over Zoom. You're going to have 40, 50 people in the room.
That doesn't happen
every bank, right? Yeah. Every ECM, the auditors, the lawyers, maybe some of your board members will join that. It's try to make it fun. It is a lot of work, no doubt, a lot of work, but that's why you have to work with good partners, to shepherd you through that process. So I think it's critical to choose the right team for you that understands your equity story, understands your company, understands your management team.
So Filippo, how do you guys set up to interface with such a large team from an internal perspective?
Yeah, as I highlighted, I think Nathan really hit it on the head in terms of it comes down to coordination, right? And I think you're going to need folks on the inside to really help you connect with your external parties. Maybe the CEO, the CFO are running some of those discussions with the banks and the equity analysts. With the legal teams, obviously you're bringing in your general counsel to help you there, and I mean that's going to be crucial to make sure that you're taking in time with your counsel externally, and then also on the underwriters council. I mean, there's a lot of dialogue that goes between those 3 parts, and making sure everybody's up to speed. And then on your finance teams, it goes certainly to a layer, making sure your auditors are on board, talking to either your CFO, your director of finance, to make sure that everything is ticking in time, that you can prepare. And I think what you've heard here is that is a long process, right? It doesn't happen overnight. I think Nathan's point about being ready to review some type of S1 or F1 at the kickoff meeting is really going to be crucial, and someone's going to have to help put that together. So it is a little bit of a work in progress, and many parts of the business have to come together. Many of the executives and the management teams have to come together to really start some of that work, and making sure that you're well prepared for the kickoff discussion to get things running smoothly. Because what you can't afford to do is, we all know, there's always market risk. And the IPO market can flip on a dime, as many of the folks on the Zoom here can talk about. And so when you want to make sure that you keep that momentum going and that you run into the kickoff meeting, the org meeting, full speed. And from our side, obviously, and it goes beyond just maybe an IPO, but additional financings. These are the same individuals are going to come in for follow-on offerings, and you'll need to have that orchestrated around your legal teams, your finance teams as well. So I think the one part there, and some of the other individuals that come into this story, is how do you tell the story? And that's going to be leaning on, as a biotech company, your chief scientific officer, your chief medical officer, depending on where you are in your pipeline and your development process. And those are going to be key individuals as well as you connect with equity analysts, because you'll go out to be able to refine your story, right? You have some insight into how you think it's going to kind of play out and how that will be received. Having spent time in equity research as well, I'd go out and speak to as many equity research folks as possible to see how they think about you within the competitive landscape, how you're positioning the story, and getting that feedback. And then that will help you really refine the handful of folks that understand your story best, understand your team best, I think, as Nathan put it as well, and how you're thinking about the future of the future path of the organization and development plan. So it's obviously it stretches across the whole management team, the executive committee, and making sure that there's coordination to get it to where it needs to be, because the timelines have shrunk. I mean, when I first kicked off an IPO on the equity research side, compared to when I was on the banking side to being on at a company now. And those timelines have certainly each year have been optimized.
So let's talk about that a little bit. I mean, just what are the major milestones in terms of selecting the team, running the bake-off, getting the documents ready? Maybe Nick, you could start, and I'd love to hear from Mike and Nate on this as well.
Yeah, apologies, Chris. You just broke up there. What was the question?
Yeah, sorry. Just asking what the major milestones are in terms of selecting the banks and launching the process. Maybe Mike, you should start. It looks like Nick has connected.
Yeah, I think Nick. I think we lost Nick there. So look, I mean, as some of you on this call know, that as part of our IR strategy, we have a vertical which we call Capital Markets Advisory Practice. And in our Capital Markets Advisory Practice, we want to help companies select the appropriate partners. And Nate, you said it. There really are partners as opposed to just vendors, banks, lawyers. I mean, they really are your partner in the success of an IPO, right? And so when we run these bake-off processes, what we do is we have a whole RFP that goes out to the banking teams, and we invite a dozen banks in to talk about the company, how they would position the company, what their commitment would be to the company, how they think about their expertise, who they play well with, etc. It is so important to have a group of folks like Stifel that does such a great job, both connecting the relationship banker, the ECM folks, and especially sales folks, which a lot of people don't talk about during this process. But my view is that specialty salesperson that is really having true dialogue post a transaction about the company is integral in this process, right? And I will tell you, guys at Stifel do a phenomenal job of that across the globe. But again, what you really want to do is have a very clear understanding of the role of each investment bank and how they're going to play well with one another and what they are going to do to contribute to the success here. And through this process, we invite everybody to every one of the banks that we invite in to talk about all of those different roles and responsibilities internally in that investment bank. And again, who they think would be the right partners to work alongside of. So that's how we think about at LifeSci Partners, how we think about being helpful to a company as they think through doing a bake-off and ultimately selecting an investment bank that would be a lead left and lead managers and co-managers, et cetera. But again, I think it's ultimately about making sure that you've got the right people that are going to follow through at the right time and have a point person in that institution that is really going to shepherd the company through that institution and truly be a champion for the company internally in that institution. Everybody is busy. Stifel is busier than anybody, Morgan Stanley, whoever, doesn't, but ultimately you've got to have somebody that really cares about you within that institution that is your champion. And so what we try to do at LifeSci is make sure that we are connecting with the right people within those institutions and making sure everybody's very clear on the role and responsibility and really understand the commitment to the company, not just for the transaction, but for the multiple transactions to come. And I think, Nate, you said it, the IPO is just one part of a financing strategy.
Filippo, from your perspective, there's 3 to 5 banks on any of these on an IPO or later on follow-ons, et cetera. Are these banks all playing the same role, or do you mix and match based on different capabilities, or what is the sort of ideal syndicate?
Yeah, I think Michael hit it on the head earlier, and the idea that you want to find long-term advisors, right? What you would hate to do is find a syndicate, put a syndicate together because you're looking for specific names to be on the cover of your IPO, and then as time in the story evolves, that maybe that changes over. You want that longitudinal kind of advice there to be a partner for longer term. And from my perspective, I think you want to make sure that you find individuals that can cover different parts of where the story may need help. for a European company who could be someone who could provide you that coverage in Europe, in the U.S., who plays nicely. I think Michael touched on this as well. You want to make sure our folks have worked together in the past, right, to make it easier for them in terms of the IPO process and the connectivity at the ECMs or the syndicate desks. And then you also look for folks who might be, at least boutique, maybe have a specific angle for a life science story. To Michael's point earlier, I think, one of the reasons why we work with certain individuals and certain banks is maybe because of the sales person who's going to be ushering forward the story after the transaction and on the institutional desk side. So I think it's you find different roles and you're able to kind of mix and match depending on them. But I think the common thread is you want to make sure you have an understanding and a partner at each one of those investment banks, and obviously connectivity to across the line, the coverage banker, the ECM banker, syndicate, but also equity research and institutional sales, and who may cover what depending on what their geography is or their expertise. At the end of the day, you just want to make sure you have all your bases covered, and really putting forward a syndicate that you feel comfortable with, not only for the IPO transaction, but for the future transactions as well, to make sure you have the right coverage as the story emerges.
And one, Chris, that also buys into the timeline too. I think going back to one of the points that you wanted to flag here, I think it's important to understand as you map out, as a company maps out their timeline, the banks, your partners are obviously on board with that, right? They're going to have obviously a large say in that. But importantly, from an operational point of view, when to go public, is there a particular catalyst, whether it's a clinical catalyst or otherwise, that we're going to use to leverage and have momentum into the public markets? Well, if there's no catalyst, is there any sort of intervening event from crossover to IPO that's going to help on the valuation side of why there should be a step up from X, and to Y come IPO, right? Understand that timeline is also very helpful. And this is where Chris, you and Mike are integral. Post IPO, what's that news flow look like, right? What's that initial key milestone that we're gonna hit as a biotech company? Is it phase 1, safety data? Is it more efficacy data for our larger 2B study? Right? Are we in a phase 3 category? Right? Understanding that, and when the investor, how long the investor has to wait for that news to occur post IPO. Right? Is it during the lockup period? Is it post lockup period? So the banks and the company, right, need to make sure that we align, and obviously lawyers get involved too, on overall IPO timeline, and not just about execution, but just how it fits with the story out of the gates for the company, right? You really want to have that momentum out of the gates as a company. Start trading nicely, helps you with cost of capital go forward with your future follow-on offerings. And then you want to have that nice news flow post IPO, whether it's submitting IND, submitting CTAs, reporting data. And this is where, again, LifeSci, comes into play and is so critical in that type of discussion and strategy discussion, really, with companies. Again, the IPO is just a point in time. It's just one major financing of hopefully many, many financings. The more important part is operationally, how are we going to use the IPO to leverage that for future success and for future capital raises.
Nick,
just to dovetail maybe on Nathan's point there, I think that view on the timelines is important from the investor's perspective as well, right? I mean, they want to be able to see some momentum coming out of the IPO, showing that there is some time frame, is it 9 months, 12 months post, that they know that they can point to and say, hey, there's something on the horizon that will help me see my inflection point and why I'm a believer in the story now. And that can, again, create momentum, not only going into that data point, but also the ability to, maybe find another financing at the other side of that rainbow.
Yeah, it's a great point, Filippo. And, that's one of the key weapons in any good banker's armamentarium, right? Taking reasons not to buy shares now away from investors. And was one of the key success factors on the Celyad dual list that we did earlier this year. Orphan indication, very high unmet medical need, and phase 3 data coming later in the year.
Let's get into valuation a little bit. Maybe it'd be interesting to hear from Mike and Nick on this. I mean, is valuation a science or an art? I mean, what's really involved in setting the valuation during the IPO process?
Yeah, so look, on valuation, I mean, this is a critical factor with any transaction, right? And you know, oftentimes now you find that the IPO valuation is pretty clear coming out of the crossover round. You know, step ups are somewhere between 1.2 and 1.7 times. You know, sometimes way north of that. You know, one of the CNS IPOs we did last week, from a crossover in mid-August, the valuation doubled in the IPO last week off the back of really strong demand. But I think, you know, the key is not dying in a ditch about getting the highest possible valuation. It's about getting the right quality investors on board through the crossover round to de-risk the IPO. And then, look, if you have a runaway success offering and you have a book that's 19 times oversubscribed and you're at 2 or 3x the crossover round valuation, that's a very high quality problem to have. But you know, you also want to know that the offering is going to trade well in the aftermarket. And you know, just going back to what Filippo and Nate were saying about the IPO just being the first step in the journey in public market financing, you know, any successful biotech is going to be a serial user of investment banking services and capital markets specifically. And, you know, if your top 10 investors are going back to their investment committee 6 or 9 months after the IPO for the first follow-on, and they're saying, hey, we backed these guys in the crossover. It was a small commitment, but we made a bunch of money going into the IPO. The IPO traded up 40% on day one. It's now trading about 80% above issue. They've just put up some great data. I want to buy more in the follow-on. That's a very easy conversation. Versus, you know, they overpriced the IPO. We lost 30% on day one. It's never touched the IPO price again. They're running out of money. Data wasn't great. You know, you want it to become a self-fulfilling prophecy.
Yeah, I mean, maybe Mike, it'd be interesting to be a little bit more explicit. I mean, of course, the board and the investors want the highest possible valuation on the IPO, but what is the danger there? I mean, if you're priced too high.
Look, I think Nick said it really, really well, right? Don't die in a ditch. At the end of the day, right, what this is really all about is demand, and particularly for ex-US companies, demand from those US investors. You know, we've experienced a whole slew of companies going public in the last few weeks, right? And some of our clients did extraordinarily well right out of the gate. Others did not. And it's interesting because, again, valuation always kind of comes up. And to your point, Chris, you don't want to set the valuation too high. You don't want to set the valuation too low. A little bit of an art. But at the same time, from our view, where we sit, and we're investors as well as we've obviously got 2 venture funds. We had 2 companies that came public last week. You know, hopes were very high, and both of those transactions traded relatively flat, right? Ultimately, at the end of the day, what you want to do is think about what the valuation that the top tier investor sets for you, right? I'm not saying you have to just listen to whatever they say, obviously, but I think ultimately to Nick's point, at the end of the day, you want to set a good memory for these investors that they will continue to fund you, and investors are very fickle. A lot of times, if you lose money right out of the gate, they want to lose your name, right? They don't want to hear from you again. And that would be really challenging moving forward. What you want to do is set the right valuation. The stock trades well right out of the gate. And then, as you know, is there's going to be serial data coming from a lot of these biotech companies that they will go back to the same syndicate of investors and have them re-up. That is ultimately the best plan. I think, again, a lot depends on the process. And what I mean by that, and that's what we go back to talking about, the process of meeting those investors, building relationships, ultimately, which leads to an IPO of a group of high quality investors that have a great experience and that you're able to come back to. The only way that you're going to be able to do that is by setting the stage way in advance, like we talked about earlier in this discussion, kind of 12 months out. And you talk about valuation through the course of that 12 months. And then again, you build credibility, and through various additional data points, you drive higher valuations. That's, in our opinion, the best way to go about this process. That makes sense, Chris?
Yeah, well, hang on, Filippo, maybe just from your perspective, the living through that, valuation discussion with the banks from the company perspective, maybe some anecdotes or just what is the emotion going on inside the company, and how do you deal with that when maybe a little bit lower valuation might be better for the company's future, but you're dealing with board members who want the highest possible valuation right now.
Again, it's a coordination, and I think what you can hear is that it's from the company side, you're looking for something that is fair, right? I mean, that is obviously there's expectations that are coming from the board level. There's expectations that the CEO, CFO are setting from themselves just by looking at the broader markets and how maybe they fit within the competitive landscape and looking at peers, recently IPO peers or other folks who are sitting in the same competitive landscape as them. So, what I would only stress exactly what Nicholas and Michael said, and the idea that from a perception out there, you want to make sure that you're having those conversations throughout, perhaps a crossover round. You're seeing the same investors who would eventually come into your IPO. There's already a sense that is established in terms of what you believe is the true valuation of the company, how that moves up or down depending on how the story evolves in that time frame. It should make it a little bit easier as when you come to the final stages of setting that up, and having those discussions with your lead banks to make sure that that you feel that where you plan to go out with a range is going to be appropriate for you. You don't want to I think have too much of a a kind of a blast off, because I think, and from my perspective at least, it feels like at least from the board's perspective perhaps, that you maybe left a little bit on the table there. So I think you want to have a kind of a nice range where you feel comfortable, that it feels good for you and the board, to make sure that that we can get something that is priced appropriately for investors to see a positive uplift as well.
Great. Welcome, Jordan. Just in time, we're just gonna turn to the listing process, org meeting to filing. Maybe you could just give us an overview of that process and what's involved there.
Yeah. So thanks for everyone dealing with my logistical issues. So what I would say, the companies will usually start talking to Nasdaq 12 to 24 months before they look to IPO. And if you think about the timeline of when you have your org meeting, Nasdaq can be very complementary to the services that you are using as you prepare to IPO. And what we really provide is perspective and data, as well as the listing qualification process that you would need to go through in order to be qualified to list on the exchange. And we recommend that companies submit their application to Nasdaq around the time that they do their confidential filing, because we will get you approved at Nasdaq before the SEC will get you approved. And it's just one less thing on your checklist of things that you kind of have to worry about as you move closer and closer to starting roadshows, test the waters, and then eventually the public offering. So we actually have a global team of healthcare folks. So Nasdaq is a 45-person healthcare team with folks in Europe and the US and all over. So we can provide local regional support too. So if there are folks on the webinar that have questions about the process or would like a timeline or next steps, we're happy to connect them with our local reps that are in your region and kind of walk you through the timeline and be very consultative. So I would say, if you're thinking about orging up and you're looking to submit your confidential filing, it's probably a good time to contact the exchange. Things are busy right now. We have a backlog of IPOs. We have 23 IPOs this week. Now, not all those are operating companies, but it is absolutely incredible. But I would say there's definitely a window now between now and the election where we're seeing a lot of acceleration in timelines and just deal flow coming to market. But it's not just an election timeline. We're having conversations with companies that are targeting first half of next year now. And, it gives us a lot of confidence that
for healthcare, this sector is going to just keep going right through the election, and you're going to see some drop off, but there's still a very strong pipeline. We have over 95 applications in house right now for healthcare companies, and that is the next 12 to 24 months, and we'll end this year probably with over 65 plus biopharma IPOs raising more than 14 billion. So back to the earlier point, from a capital market standpoint, this is by far one of the most record banner years, where I think every single IPO except maybe one in healthcare priced above or within the range.
Yeah, it's amazing. Nate, maybe from your perspective, do registrants need to select an exchange when they file, and what is a confidential filing, just in case?
Yeah, I mean, thanks, Chris. Initially, in that initial submission, no, we don't necessarily have to select an exchange. But in our space here in the biotech space, as Jordan will attest to, right, the vast majority, choose Nasdaq for reasons I'll leave to Mr. Saxe over there to explain. But you don't have to choose the exchange initially. And what I'll say, it's taking a step back from a broader timeline on process, from org meeting to pricing / closing, think middle of the fairway of about 4.5 months, right? Back, years ago, it would be 6 months, maybe a little more. Again, as I said earlier in this session, this SEC comment process is much quicker than it used to be. In that initial comment letter, if you're working with proper partners, you're getting roughly 20 some odd comments, right? The SEC is focused on balance. The SEC is still focused on making sure that you don't state that your product candidate has conclusions on efficacy or conclusions on safety. Only the FDA can say that. They're very focused on that. And then they're obviously still focused on the accounting side of things, the financial statements. And we haven't really emphasized that yet, Chris. But let me do that right now. The auditors play a critical role in the IPO process. I mentioned it briefly earlier, and shame on me for not emphasizing it earlier. But prior to kickoff, really start that process with the auditors. Start that financial statement process. Make sure that they're independent for PCAOB purposes. That's a different standard than private company. So make sure that the auditors run those traps prior to kickoff. We've all had nightmare scenarios where you come to an org meeting and auditors say, "Oh, I have an independence issue." That just derails the process. But the SEC process, it's quick, or quicker, excuse me. Think 4.5 months from start to finish. At org meeting, think 4 to 6 weeks from org meeting to filing that initial confidential submission. And so, Chris, your question, what is that initial confidential submission? Well, it's the S1, right? It's supposed to be a substantially complete document. There will be blanks, i.e. pricing. We don't know what our indicative pricing terms are going to be. There could be other blanks related to milestones that will fill in later in the SEC process. But that document that we submit with the SEC will have the lawyers and bankers will have completed their diligence, right? The bankers will have gone through committee. The auditors will have completed their financial statements, because you still have to have a signed audit opinion as part of the initial confidential submission. The confidential submission is, again, 95% of the way there to what the final prospectus in S1 or F1 will be when you launch and price the transaction. Right? The changes will be in response to the SEC. The changes also may be feedback that we get from TTW investors, right, while you're on the roadshow, the TTW roadshow, and we may want to tweak the equity story. Right? So the bulk of the blocking and tackling occurs prior to the initial submission, diligence, drafting, financial statements, and then it's about marketing, TTW, respond to the SEC comments, and gearing up and choosing the right time to publicly file your document. The document has to be publicly filed at least 15 calendar days prior to commencement of your IPO roadshow. That's just it's a technical rule that it has to be complied with. And so 4.5 months will go by from start to finish, again, middle of the fairway, assuming nothing derails the process from a market conditions, timing point of view, or major accounting issues. But that initial work, that initial 4 to 6 weeks, that's where the bulk of our process, that's where the bulk of the work takes place. And we have a near final or near complete S1 that we confidentially submit with the SEC.
Nick and Mike, what are some of the pitfalls, the mistakes that you see companies making during this process? Nate mentioned the auditors, making sure that it's at the right at the right level, but what else do you see?
Yeah, look, I think it's a great question. And without wanting to sound immodest, I think sort of collectively across the group of bankers, lawyers, auditors, IR firms active in the space, we've got this down to a pretty fine art now. We've all been doing this for 8 to 10 years in this current biopharma IPO cycle. I think, in the early days, as that market was reopening in 12, 13, 14, it was, a little bit, feeling our way. I also remember, that sort of heart-sinking moment that Nate mentioned when an auditor mentions that they're not independent in a kickoff meeting, and you just tend not to see those kind of snafus happening. I think the critical mistake that I advise clients against is not being ready to be ready. So, if you all of a sudden, have some great data, or you see a market window opening up in front of you and we're not through SEC comments, it's difficult to impossible to accelerate an IPO process. But, once you've kicked off and you've got your first set of SEC comments back, there's a pretty good glide path to getting effective if market conditions are right and the investor demand is there. So, I think it's much easier to slow down a process and wait for some data or wait for market conditions to stabilize than trying to accelerate.
Yeah, I think that's absolutely true. Spot on, Nick. At the end of the day, everybody on this call is a great partner, and the likelihood of something going wrong is fairly low. But I think from our perspective as an IR provider and partner, so important to have your message right? And that should be certainly, in stone as you are ready to go, depending on market conditions. Certainly, again, going through the process of the investor engagement, so important. Picking the right partners. One of the things we didn't talk about is also having KOL support. From our perspective, doing a KOL event where you basically serve up a KOL to those investors that you're really trying to attract, with your partners attending that as well. Making sure everybody's on the same page with the KOL community, so important, as they are third-party marketers, number one. And number two, every real investor is going to call First Thought, which is our KOL network, or GLG, or GuidePoint, and they're going to ask to speak to a clinician to do and build their thesis. So all of that is, again, so important. And I think, Nick, you said it spot on. Much easier to slow down than to speed up a process.
KOL is a great point, Mike. It's a great point, and for, they will be part of the diligence process too. The investment banks will reach out to 3 to 5 KOLs as part of the diligence process to make sure that the committee understands, a third-party independence view of your clinical programs, the third-party independence view of management teams and its ability to execute. So, just a quick practice point, and that is part of the IPO process. Part of the diligence process is for KOLs to be a part of it. And so, to the extent, as Mike noted, you could have KOLs even before the IPO process. Have a KOL event. Have them on your side. Understand, they understand your science, understand the programs. That'll only help you throughout the IPO process. And it's also quite possible that the investors during the IPO roadshow reach out to these KOLs on their own accord. They're not part of the roadshow, of course, but the investors may reach out to these KOLs in their own accord. So having those contacts early is also a really, really smart idea.
Just listening to other people's comments, the one other thing that occurs to me is make sure that you start working on your website early and get KOL details and things up on the website, and have your counsel start reviewing that early in the process. And then also, even 12, 18 months before you think about having a formal IPO kickoff meeting, think about upping your game in terms of external communications, appearing at industry conferences, appearing at scientific conferences, presenting at banking conferences, because the first question that Nate is going to ask you as your issuer counsel post kickoff meeting, when you're in registration mode, and you, Mr. CEO, say, hey, can I present at this conference? The first thing Nate is going to say, is it ordinary course? Have you done it before? And if you can point back to having done it last year and the year before, it's clearly ordinary course, and it makes it much easier for everybody to get comfortable with you continuing to do that.
Yeah, and I would just say the one thing that we've seen here is just a massive efficiency in the current cycle versus if you go back to 13, 14, and even further back, because the power of the crossover investors and the being able to test the waters confidentially and the Jobs Act have really allowed for these deals to get a lot further along in the private market, so that when you do flip over and you do start the process, you're 95% fully baked, because these roadshows are all fully covered before they launched, if not multiple times oversubscribed. So a lot of the hard work is done. If you're thinking about doing an IPO in 12 to 24 months, it starts now, versus the roadshow is kind of a dotting of the I's and crossing the T's in this current environment. Nate's being kind, but I hear the Latham clients only get like 12 comments back when they do their filings, because these things are so efficient. They can anticipate the questions before they're asked. And these companies will come to us and say, look, we're going to file in 30 days. We're going to get 12 comments back. Here are the 6 questions that we know we're going to get. And then we're going to start our launch with fully covered. And, here's the date we want to ring the bell. And that execution only happens because of a really, 2-year setup of hard work that goes, as Mike was saying earlier, engaging with investors, using an IR firm to target the right investors, think about, building your shareholder base for long-term success, as well as the conference. So I would just say, a lot of work is being done, way earlier in the process than it has been historically when you used to flip over publicly before the Jobs Act.
Sorry, we're coming up on the end here. I just wanted to cover quickly, so you filed all the documents, the SEC is reviewing it, and what goes on there? It's in Europe, we call it pilot fishing. In the US, it's testing the waters. What is the end of that process? I mean, I think, Jordan, as you said, you're sort of getting ready to have everything just set. So the IPO is really a formalization of what's already happened. But maybe Mike and Nick, you could talk about that, and Filippo, the experience of going through that.
Yeah, Mike, do you want to start?
You're on mute, Mike.
Nick, give it a whirl and I'll jump in.
Sure, perfect. So look, I think it's an absolutely critical part of the process, right? You will have a core of demand coming out of your crossover investors, that core insider commitment going into the offering. But the reality is, particularly in lockdown with these accelerated 4-day virtual roadshows, every reputable syndicate desk at every reputable bank wants to have a high level of visibility on at least 75% of the base offer size ahead of launch. And getting from your, whether it's, 30, 40, 50% commitment out of your crossover investors up to that 75% level, unearthing that demand in testing the waters is absolutely critical. And, we found this year that, it's not being treated like a pro forma check the box exercise anymore. Because it is absolutely critical now in lockdown. Some of the IPOs we did earlier this year, we were doing 40, 50, approaching 60 TTW meetings, whereas, in the past, it may have been 15, 20, 25.
Yeah, just to layer upon that, Nick, and I think that's absolutely right. And what's really amazing about the environment that we're in right now, and we see it in our practice every day, the volume of non-deal roadshows, TTW meetings, has gone through the roof. And I think the reason is because it's just such an efficient way to do meetings where management teams don't have to fly across the country, across the world. They're just doing meeting after meeting after meeting. I think we have this week alone 36 companies on the road. And the reason for that is because they can do it in such an efficient way. So when you think about TTW meetings and the environment that we're in right now, clearly those are going to be, and hopefully those are going to be meetings with investors that you've met 2, 3, 4 times already in the preceding 12 months. Those are your highest quality targets that you are meeting with before you, again, launch into this. And they are critical. When I say critical to the point where it's really fundamentally understanding what the true interest is post the meeting. Are you converting that meeting into an anchor order? Really kind of creating a shadow book in a sense. So from our perspective, as we tell every single company, those TTW meetings should be the second, third time that you're meeting with those investors to really get a good sense of what their true appetite is on the actual transaction.
Filippo, maybe just in the interest of time, we have about 1 minute or so.
Yeah, look, I think it's that conversion rate that Michael just touched upon, right? These are going to be investors that you have told the story. You want to make sure the story resonates, see if there's any additional details you can fill in for them, because they are hopefully going to be part of a major push in finding that, that number that Nicholas touched upon to assure that you have a successful IPO. So how successful are you in converting those TTW meetings is paramount. And what I will say is, Michael can certainly attest that just given the sheer number of folks who are on the road, I mean, you have to battle through some of that fatigue as well. So, right, there's investor fatigue who's sitting out there. So you want to make sure that these TTWs are of the highest, quality in terms of your ability to connect, make sure the story resonates so that you have a successful outcome and conversion, hopefully.
And just for, a few seconds, guys, I think we've come to another subject. We talked about the art of valuation, but what's the art of building the book? I mean, do you want all long-term holders that aren't going to trade your shares, or what kind of investors do you want, and who's deciding who's going to be put into that IPO book?
You want to tap every possible pool of demand in your marketing, so you've got as broad and as deep an allocation that you can put forward. But look, I think Chris, in direct answer to your question, of course you want some people to trade. You don't want everybody to just sit tight and there be no liquidity whatsoever. But I think we're seeing allocations become increasingly concentrated. Maybe 75, 80% going to the top 10, 90, 95% going to the top 20 in some of these deals. One of the dual listings we did earlier this year, we had an indication from a long-only fund in New York, an $80 million order for a $75 million deal. That fund got cut back to a $34 million allocation. But, it's very hard to argue that's not a conviction position. But, look, at the end of the day, it's the banker's jobs to advise and put forward their view of the best allocation. But ultimately, it's always done in a very collaborative fashion, discussing with management and the board.
Okay, I think we could go on. There's a lot more to discuss. We didn't get to post-IPO performance and the green shoe and several other subjects, but I'd invite the listeners. Thank you for joining us, and please do feel free to get in touch with us. You know where to find us. We'd be very happy to go into further detail on everything that we discussed and some of the things we didn't. So thank you very much. Thanks to the panelists and the audience. Have a good day, everybody.
Thank you. Thank you, Chris. Thank you all.
Thank you. Thanks, everyone.
Bye.
Bye-bye.